Market opens with a gap down. Strong selling continues and breaks the previous day's low. But we don't jump in yet. We wait for a pullback. Then we plot a 50% retracement, which aligns with the previous day's low, now acting as resistance. A reversal doji candle forms right at that level. We project our stop loss and target and take the short entry. If you have found it difficult to decide where to enter or exit the trade, this video will help you. Stay till the end to learn all the details. The trade moves in our favor and we hit our target. Please subscribe and hit the bell icon. Hello traders, I am Kabi Chandra. In this video, we are diving into the most powerful concept, price action, including market structure, fair value gaps, and how to identify key buying and selling zones. Understanding these concepts will help you make better trading decisions and improve your overall strategy. Let's get started. Before making any trading decision, we need to understand the market condition and market structure. If you take trade without knowing the market conditions, you are making a mistake. Understanding the market condition before trading will improve your results. An uptrend is when price forms higher highs and higher lows, showing buyers are in control. A downtrend is when price forms lower highs and lower lows, indicating sellers have the upper hand. A sideways or range-bound market is when price moves within a range, bouncing between support and resistance without forming a clear trend. Recognizing these patterns helps us identify potential trade opportunities. Just like dancing to the right beat, you should move in sync with the market's rhythm. Otherwise, the outcome may not be favorable. A strategy that works well in trending market may not be effective in a sideways market, and a sideways market strategy may fail in a strong trend. You should trade according to the market conditions. Adapting to the market conditions is key. It's the foundation of successful trading. Please subscribe, hit the bell icon. This is a green candle that indicates buying pressure. The bottom of the body is the opening price and the top of the body is the closing of the candle. Price opens here and closes here. That means the price has moved up during this time period. The lowest bottom of the wick is the low of the candle, and the highest top of the wick is the high of the candle. Let's compare these two candles. The current candle's high is higher than the previous candle's high. This is called a higher high. Also, the current candle's low is higher than the previous candle's low. This is called a higher low. This pattern of higher highs and the higher lows represents the structure of an uptrend. The uptrend continues. Each and every low is consistently higher than the previous low. This is known as one-time framing. We consider this kind of steady uptrend as a single leg move, where the price rises without any pullback. The red candle is the opposite of the green candle. It opens higher and closes lower. The high and low remain unchanged, no matter the candle color. The top of the wick represents the high, and the bottom of the wick represents the low. Here we have a one-time framing single leg downtrend. I hope you understand why I am calling this a one-time framing single leg downtrend. If it's not clear yet, feel free to rewind and watch the explanation again. Look at the last green hammer candle. It still remains the lower low and lower high structure, but it closes above the previous candle's close. Unlike the earlier candles, this one stops pushing lower and finishes stronger, closing above the previous close. This shift in behavior could be an early sign of slowing down of the bearish momentum. I am not calling this a trend reversal. The price can still continue to the downside. What I am saying is this candle serves as an alert, a warning sign that the momentum might be shifting. After this hammer candle, the next green candle breaks the high of the hammer and forms a higher high. Also, its low is higher than the previous hammer's low. From a candle by candle perspective, this makes a trend change. We are analyzing the structure candle by candle, observing small shifts in momentum. But if we zoom out and look at the broader picture, this still doesn't qualify as a trend reversal. from the bigger perspective, the overall structure remains bearish. Why do I say this? Because as we discussed earlier, we considered the previous downtrend as a single leg move. This candle by candle structure change. Although it shows an uptrend structure, it is still a smaller structure, or what we call an internal structure. It hasn't yet broken above the top of the single leg move. So from a broader structural point of view, the overall downtrend is still intact. We'll discuss this in brief, but before we dive into the bigger picture or broader market structure, let's first take a moment to go through a few examples of candle structure, so we can better understand how each candle contributes to the overall trend. Let us discuss another condition. What if the candle doesn't break the previous candle's high or low? In other words, what if it's not a higher high or a lower low? Here it is. The high of the candle doesn't break above the previous candle's high, and the low also doesn't break below the previous candle's low. That means both the high and the low are contained within the range of a previous candle. In candle by candle terms, we call this an inside bar. If this occurs within a broader market structure, we refer to it as a pullback or a range-bound phase, a period of consolidation where the market pauses before deciding the next direction. Before diving into real charts, let's first summarize what we have learned about market's condition and market structure. There are three main market conditions: uptrend, downtrend, and sideways, also known as a range-bound market. We have already discussed the basics of each of these market phases. We have seen that the market generally moves in three main conditions. Uptrend is where price consistently makes higher highs and higher lows. Downtrend is where price makes lower highs and lower lows. And a sideways or range bound is where price moves within or outside a defined range without clear direction. Understanding these conditions helps us read the overall market structure, identify the current phase, and prepare for the next possible move. Now, let's move on to the real chart and discuss everything more clearly and in details. We'll apply what we have learned and break down the market structure candle by candle, so you can see how trends and phases unfold in real price action. Like we talked about earlier, this is a clear one-time framing uptrend, also known as a single leg uptrend. Compared to earlier moves, this candle, the upside extension on a close-to-close basis, is noticeably smaller. Also, it's obvious that the upper wick shows some selling pressure. Let's see the next candle. Okay, here it comes, a red candle. This red candle doesn't break the previous low, so we are still in a one-time framing uptrend. Interestingly, the leg to the upside is extended by the wick of this red candle, so we extend our structure mapping line. Now, the next green candle makes a lower low compared to the previous one. It breaks on the lower side. This means the one-time framing uptrend is now invalid. In simple terms, we are seeing a pullback. Another observation here is that the high of this candle is also lower than the previous high. So, candle by candle, we now have a lower high and a lower low, which indicates a downtrend. Remember, this is a candle by candle structure, also known as internal structure. You can also call it a fractal structure. Very interesting. Next, we see a red shooting star candle, indicating selling pressure. However, it still forms a higher high and a higher low compared to the previous candle. According to structure mapping rules, we should draw an uptrend line here. This qualifies as an internal uptrend structure. Let's see what happens next. Now, we get a big red candle. On a candle by candle basis, it forms a lower high and a lower low, which indicates a short-term downtrend or internal structure downtrend. So we draw a downtrend line. Also, this red candle breaks the previous internal structure low. That means the internal structure itself is now forming a lower high and a lower low pattern. Remember, this downtrend is just part of the internal structure. Our bigger picture, high and low, are still holding. All of this internal movement is happening within that broader range. It's just like we discussed earlier, price is moving within a defined range between a major high and a major low. All of this internal structure, including the complex pullback, is unfolding inside the broader range. Until the bigger structure breaks, either to the upside or downside, we treat this internal structure as a pullback. When an internal structure, downtrend or uptrend, forms within a pullback, like we have seen here, it's called a complex pullback. And complex pullbacks aren't easy. They can easily confuse to trap traders who don't understand structure mapping. After the pullback, price resumes its uptrend and breaks the previous external structure high. Traders who thought the pullback was a trend reversal and entered sell trades are now stuck in losing positions. This is why it's important to differentiate between a true reversal and a pullback, especially when complex pullbacks are involved. And this is exactly where structure mapping becomes so valuable. It helps us stay aligned with the market context and avoid getting trapped in emotional or premature trades. If you are finding this explanation helpful, make sure to subscribe to the channel. Help me to improve my YouTube algorithm. I will be sharing these kinds of insights regularly to help you improve your trading step by step. Don't forget to like the video and drop a comment if this part gave you some clarity. I'll explain these kinds of concepts even more clearly in the upcoming videos. Okay, let's continue. If the breakout sustains and the uptrend continues, we will adjust the previous support level upward to align with the recent pullback low. The pullback low will act as our new support level, and the last red candle before the breakout will be identified as the bullish order block. After the breakout, price form a fair value gap FVG around the previous resistance level, which aligns with a bullish order block and can act as a potential re-entry zone during a pullback. In fact, most of the time when a breakout occurs at a key resistance or support level, an inefficient move or FVG typically forms around that area, and such FVGs often prove to be highly effective for re-entries. Here we have a fair value gap FVG, so let me explain what a fair value gap is and how to identify and mark it on the chart. A fair value gap is an imbalance or inefficiency in price action, usually caused by aggressive buying or selling pressure that leaves a gap between candles, where a little to no trading took place. This gap often represents areas where institutions entered positions quickly, and price may revisit it later to fill that imbalance. How to mark a fair value gap? Look for 3 consecutive candles. Focus on a strong move, usually after a breakout or a high volume push. In an up move, identify the high of the first candle and the low of the third candle. If the low of the third candle is significantly higher than the high of the first candle, leaving a gap in between the high of the first candle and the low of the third candle, that's your fair value gap. In a down move, do the opposite. Mark from the low of the first candle to the high of the third candle if there is a clear gap. Here I have marked a narrow range fair value gap because a portion of the original gap has already been mitigated by this green candle, so I am only marking the remaining unfilled part of the gap. Let's get back to the chart we paused earlier and continue analyzing it. Now let's mark this fair value gap and observe how price reacts around this zone. Shall we mark these 2 red candles as a pullback like this? No, we won't. That's because both of these 2 candles are completely contained within the high and the low of the previous green candle, so they don't represent a meaningful pullback in structure mapping. We will mark the price movement up to this high as a single leg, and at the top we will mark this red candle as a pullback because it breaks the low of the previous candle. This is how we mark market structures. We will dive deeper into the details in the next video. Before we end this video, let me quickly introduce the basics of marking order blocks. In the next video, we will dive even deeper into the concept. When price makes a higher high, it means the previous high has been broken. This break of the previous resistance is referred to as a break of structure. At this point, we typically identify a bullish order block, which is found at the lowest point of the preceding pullback. Let's look on the real chart. Here, price has broken the previous resistance level, which we identify as a break of structure. The lowest candle of the pullback before this breakout is marked as the bullish order block. Similarly, when a low is broken, that level is identified as a break of structure to the downside. The highest green candle in the preceding pullback is then marked as the bearish order block. Let's look at the real chart. Here we have the break of structure, and this is the bearish order block. Understanding price action, internal and external structures, complex pullbacks, fair value gaps, and order blocks can give you an edge in the market. It's not about guessing, it's about reading the story that price is telling. We saw how each candle adds to that story, how market phases develop, and how structure mapping helps us avoid emotional decisions. In the next video, we'll go even deeper. If this video helped clarify your understanding, don't forget to give it a like and subscribe to the channel. Thanks for watching, and as always, trade with purpose, not emotion. I will see you in the next one.